Back to Coffee with Krav. Well, I'm thrilled today to have our first repeat customer at Coffee with Krav. Jack had come on back in September of 2000. Obviously, a lot of other things were going on at that time, a lot of different things that were going on at that time. But, today, what we're going to be looking at, a whole bunch of things. We're going to ask Jack what's going on in the economy, the markets. We're going to talk about interest rates. We're going to talk about recession. Is it coming? Is it not coming? What's going on with that? Different opportunities in the market. So I can't think of a better person than Jack. And Jack is also testing us in the beginning of the day because he's going to be on Bloomberg later on the day. China he's talking to, so he's got a full schedule. So for those of you who didn't hear Jack the first time, Jack Janasiewicz is a senior vice president, portfolio strategist, and portfolio manager at Natixis Advisors. He's responsible for providing insight and analysis on global economic and capital market themes and their impact on portfolio construction and asset allocation. He has over 20 years of investment experience. Prior to joining Natixis, Jack was chief strategist at Duet Alternative Investments, where he assisted in managing an absolute return strategy, focusing on emerging market investments and also direct research related to asset allocation decisions and security selection. His previous positions included 9 years as chief strategist and portfolio manager for a long-short global macro products at Macquarie. Jack also holds a BA in economics and an MA in economics from Boston University. He's a member of the Boston Security and Analyst Society. Jack, welcome back. Good to have you back.
Great to be back, and I'm excited that I'm the first repeat customer here. This is great.
Yes, absolutely. So this has been some year, Jack. Usually, when you get a bear market, at least the bond market can pick us up. This time is different. There's almost no places to hide. Let's go backwards. Let's reflect on the market. Let's see how we got here, where we are. We're going to go over what's going on future-wise in the market, but let's just take a quick step back. Let's lay the foundation. Let's take a look at what brought us here now.
Yeah, and it was a series of shocks, right? If you start to think about it, we started with the COVID-induced shock. Then we started to come out of that, and then as we started to come out of that, we got hit with another wave of a different strain, and it felt like we were finally getting around the corner with that. Then you have the Russia-Ukraine conflict, so that starts to see the spike in commodity prices. Feels like we start to get that under control, and then we have the zero COVID policy coming out of China. So it would just seem like as soon as we were maybe getting around to overcoming that first shock, the second one hit, and then the third one hit, and then the list goes on and on. So it almost really never gave us a chance to recover, and it was just one punch after another. And here we are, and we're still arguing over whether we're going into a recession or not. And so, given all these things that continue to sort of hit the global economy, things are still holding up really well, relatively speaking. If you want to take a look at the big picture there.
Well, speaking of punches, probably the biggest punch, maybe a Mike Tyson knockout, has been inflation, right? So I want to get your thoughts on inflation. Have we reached the peak inflation? But even if we reach peak inflation, where are we going to go from here?
Yeah, and that's going to be, I think, the key to the markets going forward, right? And, I'm happy that we started off talking about sort of those consecutive gut punches, if you will, because it was just one supply shock after another. The response that came out was basically to hand out stimulus checks, really pad sort of that the consumption backdrop. And the problem that you had is you basically were able to retain your consumption power at the same time that we were basically in a supply shock. So everybody still has the capacity to spend. That spending all shifted really from services because we were in lockdown, couldn't really go out, to goods consumption. But the flip side, the supply side on the goods portion of the marketplace had basically gone into recession mode, which is shut down. So it's not surprising that all of these things filter back into higher prices because everything turned into being one-sided. And the clearing mechanism to get to that equilibrium level is higher prices in here. So if you sort of think about where we are today, we certainly have plenty of evidence that those supply side shocks are slowly getting corrected. We're hearing from a lot of the retailers, for example, that their inventories are bloated because basically as the supply chains issues start to free up, a lot of these companies have, or a lot of these retailers have maybe double ordered to make sure they get enough inventory to come in. And at the same time, now the consumer's shifting. We did enough consumption of goods during COVID. Now we can get out and about. Hey, we want to go out and do things, right? We want to go out and experience things. This is the services side of the equation. And that's where there's another shortfall, right? We're still trying to get labor, employees back to the services side of the economy. And that's where all the consumption is right now. So we keep seeing this shift, but the markets or the supply side seems to be always one step behind because they're trying to catch up. And that just continues to put upside pressure on prices. So I guess to come full circle, we are seeing a deflation or disinflation on a lot of the good side of the equation. And that's where we're starting to see a lot of the normalization coming out of these supply shocks, where we're seeing the more sticky portion of the marketplaces on the services side. And that's where I think we're going to have a little bit more of a fight with inflation going forward. But, have we seen the peak in inflation? We certainly think so. How it manifests over the next couple of quarters, though, will be a little bit more interesting. But we are certainly seeing signs of disinflation, especially on the good side of the equation, which I think is putting peak inflation behind us.
All right. Well, the Fed seems obsessed about 2% inflation, getting back to 2% inflation, and that can't happen for a period of time. Is there flexibility on that number? Do you think that the Fed might come back and say, hey, 2.5 is okay, 2 3/4 is okay? What's your thoughts on that?
Yeah, Mark, I wish maybe I could have been able to do that when I was in college. Maybe an A and a B, I could move the goalposts around. Things might have been a little bit better on that outcome.
You didn't do that?
I think moving the goalposts is probably not the right answer in here. And I think if we were to do that, you could maybe question the credibility of the Fed in terms of its inflation fighting credentials. So, that's maybe a more of a semantic argument, but I think at the end of the day, you have to stay with that 2% target. And I think moving that is probably not the right solution. I think you'd have a little bit of a risk of confidence if we were to do that. So I'm not a fan of that one.
All right. Well, interest rates are tied to inflation picture, right? So the talk right now is terminal rate is 5 to 5.25%. Are you in that camp? Do you think that we'll exceed that? What's your thoughts on that?
Yeah, and so again, that terminal rate obviously is where the market sort of thinks the peak in the Fed rate will be. If we sort of look at the charts that we follow that sort of try to capture, where does the market continue to think that terminal rate is? We've been sitting at that 5% rate basically since the beginning of October. And so a couple of things manifest from that, right? The Fed has a couple of levers to pull. The Fed can obviously hike rates at a speed or a pace. The size of those hikes matter, and then the duration at which we stay elevated matters. And I think because we're getting closer to that terminal rate of 5%, we've already heard from Jay Powell and a lot of the other Fed speakers that, the pace can slow now, and you're going to rely a little bit more on that length at restrictive levels, if you will, for longer. And so that to me tells me we're pretty close to the end if you believe the market. And as I said, that terminal rate based on Fed fund futures and euro dollar contracts and all these interest rate derivatives, we've been sitting at about 5% over the last, I would say, 2 months almost. So it feels like that 5% level is the right one. Obviously, then it's going to be a function of what inflation does going forward if we need to see some minor tweaks at the edges. But it feels like the Fed is moving to duration, which means probably sit at 5% for a while before we start to move anywhere from there.
Okay, so with that in mind, bonds have done terribly. This is one of the worst bond markets in history. I actually looked at history, and 1700s, 1800s, 1900s, and the 2000s, it was 4 times where the bond market had horrible rates, and this is one of them. Yep. So once a century type of return negative on the bonds. Just an overall thought: is it time to start stepping in? Is it still too early? What's your thoughts on bonds?
So I think when we start to think about that terminal rate at being 5%, and it feels like we're sort of at that sort of equilibrium point, to me, when you start to think of the upside downside capture, when you think about, let's say, I think the 10-year got up to about 4.25. At that point, if you believe that inflation is largely cresting, which is our base case, the idea then becomes, well, what would cause rates to push higher? And it's going to be obviously inflation. So if you think inflation's cresting and moving lower, then you probably have to argue at 4.25 that you probably have seen a peak in rates. The question, though, is how much farther down can you go? But the point being, I would say you probably want to start dipping into owning some fixed income in here. And, we've been talking about maybe even putting a little bit more risk on, if you will, which means maybe high quality bonds might make some sense in here as well. Because if you think about where we stand with regard to the corporate balance sheet, it's actually very, very strong. And this is enough, I think, something that we're not used to seeing going into potential recession. So, back to your point, if you think inflation has crested, what's the biggest risk to bond yields pushing higher? Higher inflation. It certainly feels like, that's behind us now, especially when you think, monetary policy acts with a long and variable lag. You still have plenty of those hikes in the pipeline working its way through, which should continue to put pressure down on inflation. So I think at this point, the fixed income is starting to be attractive in here. So we're certainly advocates of owning some bonds in here.
I read yesterday that 40% of the corporate bonds are coming due in the next couple of years. So a lot of these bonds had low rates, and now they're going to be coming due at higher rates. Is that a concern of yours at all?
Yeah, and I think the issue there will be it's a timing thing, right? In between now and then, a lot of corporates, did the right thing, which was while we were in the midst of COVID, the Fed basically tried to backstop the credit markets, keeping them open, keeping access to financing open. And we saw a bunch of corporates basically refinance to lock in those super low rates. Those are going to be coming due. But in the meantime, that sort of bridges the gap between now and then. And when I say then, I'm saying then as being maybe the other side of the potential recession. So as we're starting to come out, the economy is starting to reaccelerate. That's probably the time in which a lot of these companies are now going to start to see those revenues picking back up. So their ability to finance themselves going forward starts to improve again. And at that point, maybe we start to see rates sort of settling in at a lower level. So you're bridging the gap between now and then. You don't have to worry about maybe refinancing at significantly higher rates. Those rates come down a little more when some of that bond payments are due. And, at that point, things are a little bit better on the econ front. And so, maybe, at the end of the day, we're refinancing at slightly higher rates, but I don't think it's going to be prohibitive going forward either for corporates.
All right, well, let's talk about that dirty word, that R word, recession. A lot of the press, a lot of the shows on TV, they're talking about recession. Just wanted to get what your work is and what you guys feel. What percentage, if you had to put a percentage onto it for 2023, is it 25% chance, 50%, 75? Are we definitely going into recession? What's your thoughts on that?
Yeah, you're not going to pin me down on a percentage.
Ah, come on! It's just us guys talking. Come on.
This is what I always say when we start to write our 2023 outlook, right? It's like, listen, if I get this right a year from now, let's be honest, I got lucky. If I get it wrong, you're just going to tell me how stupid I am. So there's zero upside for me on these kind of things. But I think the bigger point to take into consideration here is, first of all, let's work on the extreme scenario, right? A deep recession. And to get a deep recession, you need to see a lot of corporate America being caught off sides. And when you get caught off sides, it basically means I have to suddenly cut back on CapEx. I have to cut back on investment. I have to cut back on overhead. I'm going to have to start drawing down my inventory. You're basically not prepared. And as a result, you have to overshoot aggressively to the conservative side in a real short time span. I would argue that this might be one of the most telegraphed recessions if we get there in history, so to speak. So I think those excesses, the corporates being caught over their skis, so to speak, I have a hard time with that. And so I think even though we expect the economy to slow, to get into a deep recession requires a little bit of surprise. And I don't think you're surprising anybody at this point if we were to see that. So our odds of a deep recession are pretty small at this point. But then it becomes a question of a mild recession, or can we even avoid a recession? I would argue more recently that we were in the mild recession camp, but I think some of the data is giving us a little bit more credibility to say the odds are improving that maybe we don't even have a recession. I would also argue recession is, again, it's a mathematical term, so we can argue about a definition behind that. My eyeballs are what tell me, are we in a recession or not? And I look at really the labor market, right? Are we seeing a lot of people losing their jobs? Are we going to see that unemployment rate shoot from 3.7 up to 4 or 5%, something like that? That to me is a pure definition of recession, but that's not what the people that sort of describe the recession or make the recession call label it. So a little bit of a definitional issue, but again, keep in mind, and this is something I think that maybe people don't appreciate. If I look at the labor markets right now, there are roughly about 7 million people that are not in the labor market today compared to where we were pre-COVID. Where are those people? Well, a lot of people just have not come back to work because of some COVID-related issue, right? The BLS does a survey where they say, why are you not at work? And there's a bunch of different responses you can have. And one of them is, I'm not at work because I'm afraid of COVID. I'm not at work because I have COVID. I'm not at work because I'm taking care of someone with COVID. I'm not at work because I have a child who doesn't have daycare. Tangentially, that's related to COVID. I have a child at home because we're at hybrid with education. Again, a tangent of COVID. The point being, if we kind of get past this COVID backdrop and people then start to come back to the workforce, you've got potentially 7 million people that are coming back in to basically increased supply of labor. Well, what happens if the supply of labor increases? That's going to increase competition, which means wages probably start to come down. So there are ways that we can get to a soft landing. One of them being we can bring the labor market up. The other ones I would point to is simply, so far we really haven't seen a massive reduction yet on the labor front side. And yet we're seeing signs of disinflation. We talked a little bit about this a couple minutes ago, but in the good side of the economy, we are seeing some disinflation pull through. It's just a question of how much will the goods disinflation work its way through, and then how much of that's going to be still relying on maybe a healthier labor market than we're thinking about. But a combination in there can get us to a soft landing where you don't have to have a recession or a deep recession anyway. So maybe it's 50-50, maybe a little bit more skewed higher for a recession, but to me, I still think we're in the mild camp. And there is some probability that's slowly increasing that maybe we don't even get a recession.
Do you think, because you mentioned about the 7 million people that kind of disappeared from the workforce, do you think a fair amount of them are permanent? Like they were maybe a certain age and like, I'm not, I'm done. I'm out of here.
I think there is some of that. It's interesting. There was a Fed paper that just came out. I can't remember which Federal Reserve Bank wrote it. It just came out, I think, maybe over the weekend, where they talk about early retirement, basically. And they go through and say, historically speaking, when we have seen early retirements like this, those people tend to come back into the labor force, so they actually unretire. And if you sort of think about it, as when do people take that early retirement? They get those early retirement packages. Why is that? Well, it's usually because the economy slows. We're looking at cut headcount, so we're going to offer up those packages to maybe get a few people to take early retirement. That's our headcount reduction going forward. But if we actually end up going into those recessions, which is partly why you're reducing headcount, what happens? Well, the stock market usually corrects. So these people who took early retirement look at their 401k and say, oh, wait a minute, maybe I'm not sure I want to be retired. And guess what? They end up coming back. And we haven't seen that sort of thing happen yet. There's some stats that we follow, one of them being the labor force participation rate for the 55 and older crowd. We haven't seen that sort of trend where they retire and then unretire. So that's one of the areas where we have seen people, and it makes some sense to think about what happened in the midst of COVID, right? You had a massive run up in equity, so your 401k could have gone up 50% plus. You had your house price appreciation go crazy. So you're feeling pretty good about taking that early retirement package. We'll see when we get to the other side of this if that still holds up. But to your point, yeah, some of those people are basically potentially permanently gone from the labor force. But the number that I cited of close to 7 million, that's actually just looking at those people responding to the COVID-related issue. So I'm not even considering those people unretiring coming back into that 7 million number that I threw out.
Okay, interesting. In our last conversation back in September of 2020, we talked about how the largest 1% of the S&P 500 made up 23% of the index, and that same largest 1% of stocks accounted for 34% of the Russell 1000 growth index, and an incredible 48% those few companies made up 48% of the NASDAQ, and those 5 stocks were Apple, Microsoft, Amazon, Google, and Facebook. Now, these stocks are down this year anywhere between 30 to 65%. It's a pretty significant drop in those companies. Should we still be worried about those stocks? Is it starting to get, is there a value there? Should we take a peek at it? Do you have any thoughts on that?
So, a couple of things. It's not surprising they're down that much. If you think about it, and if you reference the stats that you just spoke to, there's a lot of people that own these stocks, obviously. And so when you see sort of the drawdown that we had gone through and people start to get nervous about the economic backdrop, they're going to sell those positions off. So the ones that have the biggest holders are going to be subject to the liquidations that we saw. So it's not surprising, that we're seeing some of these, they were outsized winners. People are going to be those selling those winners to take profits. And there's a lot of people that own those same FANG names, so to speak. And also FANG was a pretty good beneficiary of sort of that stay-at-home economy, if you will, too. I would argue, though, that as we sort of come out of COVID and come out of this sort of downturn and start to reaccelerate back to the upside, maybe the leadership does change going forward. And so, I still think the leadership manifests itself in tech, but it's probably going to be manifesting itself in different tech names. So you may not see the Googles, the Apples, the Amazons leading us out and significantly higher. It might be some other names, and you can kind of make some arguments for whatever that sort of that tech space may be, but there'll be somewhat of a baton handoff, if you will. And so, should we expect at least a recovery in some of them? Yeah, maybe just because of the technical pressures that I just spoke to, that, a lot of selling that occurred there. People are maybe trying to cover shorts in here. That might give a little bit of a near bid. But I think you are going to see a little bit of a leadership change coming out of this. So I would expect, maybe they're at least market performers, but maybe not. They're going to have that same outsized performance that we had seen in the previous decade, if you will.
So, yeah, that's interesting that you say about leadership. It seems like each time that we have a downturn, or bear market, there's different leadership that takes over. So technology, if you go back to the 90s, it was energy, small caps, 2000, 2010. So any idea, or is there any indication, energy, or is there metals, or is there any areas in particular that you think will grab that leadership over?
I think some of this can manifest in, and you mentioned one, energy, I think is an interesting backdrop. If you think about transition from where we are today to green, you can make the argument that maybe we try to do that a little bit too quickly, right? You still have to kind of get from here to there. You don't just start here and get here tomorrow. There's a transition period in there, right? And that transition period may have been overlooked and as a result underinvested. And, maybe there is some benefit on the energy side still, even as much as we've run up. And I think it's also pretty easy to ignore the energy space right now because it's not really a big portion of the index. However, you've seen some outsized gains in that side. So, I think from an investment perspective, to basically bridge the gap to us to get to the green side, we still need to have oil. And I think there is maybe a case to be made here where there's been enough underinvestment that, that might have to change a little bit in the near term to get us to that sort of green backdrop, if you will. The other argument you can make too, we've seen a little bit of a shift in the world order, obviously with Russia, Ukraine. People are looking to get away from or divest away from Russian oil. So that also, I think, puts a little bit more of a bid to maybe potentially looking at some of the U.S. producers again. And then also think about at some point, China and zero COVID, we're seeing a shuttle shift right now. If we look out a year from now and China's completely reopened, you have to think that there's a pretty significant amount of demand that's going to come out of there for commodities as well, and specifically oil. So I think there's a case to be made where energy probably might have some upside in here over the next couple of years. And the other one too, think about it, again, what do we learn coming out of COVID? You probably need to have a little bit more of supply chain diversification, which means that reshoring, friendshoring, however you want to call it, but as sort of, and we've already seen this with the CHIPS Reduction Act there, or the Inflation Reduction Act, where, we're really trying to focus a little bit more on bringing semiconductor production, chip production back to the United States. You're going to see some of that, I think, continue to work its way through. So that could be very good for domestic companies that are in the manufacturing side. So think industrials and even think small caps, big beneficiaries of that reshoring, small companies. And that's, I think, another place where maybe we could see some of that shift take place as well. So a couple ideas in there to consider.
Yeah, you mentioned about energy, and that's interesting because back in the 90s, energy made up 23% of the S&P 500. It got down in the pandemic 2020 April down to 2.5.
Yeah.
And now I think we're sitting about 5 or 6% of the S&P 500. So even if it and I've read some experts that feel it can get back to 11% of the S&P. So that's still a significant move on the upside from here. That's a double from here. So
yeah, and think about it, right? I mean, a 2% allocation to the index, that's easy to just say from a portfolio manager's perspective, 0. Right, 2 is equal to 0. Let's put our money elsewhere, and so I think even today, if you look at just where institutional investors are positioned, I would argue they're probably still underweight on the energy complex.
Okay, good. Well, I want to talk about stock market valuations. I think we're around 19 times earnings, somewhere around there. So, a couple questions on that. One, is that a good number now?
Yep.
Also, if you take a look at next year's earnings, which is still looking like it's going to have growth numbers, should that be growth numbers? And if we do hit a recession, should the analysts be lowering those numbers? So just wanted to get an idea of valuation as it pertains to today, and then looking at next year's earnings numbers.
Yeah, and this is obviously, I think, one of the key arguments that we've been having here internally. And just to kind of take a step back, the valuation argument is a challenging one because to me, it's more of it's a reflection of an opinion, right? You may want to pay up 20 times for the market. I may be saying that's too rich, so I'm willing to pay 15. We can go back and forth on this. There's no absolute number that's right or wrong. It's just a reflection of what price are you willing to pay versus what price am I willing to pay. And so that's the argument that makes this very challenging to say, are we expensive or rich? We can look at the historical multiples, and certainly at 18, 19 times, you could argue it's still a little bit on the rich side. But what's interesting, if we just look at the relationship between interest rates and forward PEs, and we tend to look at just the 2-year yield, there's a pretty good relationship there. It's obviously as yields push up, multiples come down, so you have to sort of take the inverse of the yield when you're looking at the PE, but they tend to move in lockstep. And more recently, we're seeing a little bit of a gap opening up. Why is that? Well, this sort of gets to your earnings comment, and in our conversations with clients, one of their biggest concerns they have, if we're about to go into a recession, earnings estimates may still need to be revised lower. And there's certainly, we're not arguing that, but I think what's interesting, if you go back and look in history, earnings estimates tend to be somewhat of a lagging indicator, right? Stock prices will actually turn well before we get a trough in those earnings estimate downgrades. And so, we've looked at probably 8 or 9 different sequences where we've had peak earnings and then we've had a sell-off. Earnings estimates have to come down, and we plot them on a time axis there. And what you see is, as those earnings estimates are still continuing to grind lower, equities turn about halfway through that earnings downgrade cycle. So if you sort of look at the historicals, in terms of peak to trough and timing, we're at close to that halfway point from a timing perspective. So the argument we make is that, sure, we could continue to see earnings downgrades and earnings estimate downgrades, but equities bottom about halfway through that cycle. From that time perspective, we're about halfway through right now. So if we think about this relative to the valuation metric, right, everybody's going to say, well, I'm going to take my PE multiple, multiply it by my earnings estimate, and that's what the fair value of the S&P should be. Well, if our earnings estimate continues to trend down, but stocks are bottoming, just by pure math, you now have to have a multiple expansion, right? And that's sort of what we're starting to see. So there's some evidence that historically speaking, we may be at that inflection point. Maybe, we'll see. But we're starting to get a little bit of that divergence. Rates are pushing higher. PEs are now pushing higher. That's not usually what happens. Is that simply because we're at that inflection point? Equities have already figured out that the market forward discounting mechanism is already looking out to the other side of this, so to speak. Estimates still have to come down, but equities are starting to turn. As a result, just by math, we're getting a little bit of expansion. That's one of the things that we're taking a look at here. So again, yeah, we certainly understand and appreciate that earnings probably do need to be revised lower. The stock market's going to turn well before that trough actually hits.
So Jack, are you telling us that the market has reached the bottom? Is that what you're telling us here on Coffee with Krav? An exclusive? Is that what's going on here?
There are possibilities that we may be close to at least maybe not making new lows from here. How about that?
Okay. All right. I think you hedged yourself very, very nicely. So with that in mind, do you want to give a prediction on where you think the market will wind up next year?
Well, if I get the third call back, that would be another history, I think, at that point.
That's right.
When we have that third conversation, that will be off the lows and certainly no longer worrying about that downside, if you will. We'll be talking about upside opportunities in here. Listen, at the end of the day, the rates are still, I think, getting closer to the end of this. I think you're going to see inflation numbers coming down. The question is, if we go from 9% inflation to 5%, we need to go from 5 to 2. That's the labor market issues. Might that take a little longer? And I think that's where the big questions are going to be. And to me, that's probably going to happen maybe over summer. So that's where I think you're going to have another sort of, the market's going to have to sort of straighten itself out again.
All right, Jack. Well, we'll have part 3 if you're right. Okay. So I mean, just put it out there. So where do you think there's today? Now, where do you think there's? I mean, we talked a little bit about energy. Outside of energy, where else do you see some opportunities in the marketplace? And it could be anywhere. It could be commodities. It could be stocks, bonds, alternatives, whatever. The whole universe.
Yeah, so we talked a little bit about energy, a little bit about the industrial complex. I think there's some upside there. I mean, just to throw a couple things out. If you look at what's sort of not normalized yet from pre-COVID levels, the auto industry is certainly way behind. So you can certainly continue to see auto production picking up. And we're seeing it in things like Boeing, for example, ordering new planes. I think United just put a pretty big order in over the weekend or was talking about it. So if you look at sort of the aircraft portion of the economy, that's still lagging behind. So just looking at normalization, there's some portions of the industrial space that have some catch up to do. So that's part of the other areas of the market that we like. I had mentioned earlier, we sort of, we think that you should be tiptoeing out a little bit farther in credit, and as a result, from a bonds perspective, we think investment grade is interesting. So from that perspective, I think we're still looking at some imbalances that are out there. So it's, it's just going to be an issue of supply and demand, and especially if China starts to.
Heard something about China. So if you could just repeat a little bit of what you were talking about with China again. Sorry.
Yeah, so the comment on China, as China continues to reopen and get away from zero COVID, their economy is going to start to pick up again. And I think that's going to also help the commodity complex. I still think we're short commodities right now. It's a supply and demand issue. There's still not enough supply out there and there's still plenty of demand. So you could also see the commodity space perform fairly well in here too.
So speaking of commodities, what's your thoughts on gold? It looks like recently it's been picking up. Yep. So you think that could be a good 2023 opportunity?
Yeah, I think gold is going to be it's a good diversifier in a portfolio. We've also heard about, the cryptocurrencies for a long time there where they were talking about that replacing gold. I'm not a crypto fan. I just don't see any value in it. And so I think there was a little bit of a competing asset class for gold in the cryptos. And I think we're sort of seeing that flush its way through the system. It wouldn't be surprising if we see some of that more back into the hard commodity space, the precious metals. So I think that also is supportive. So, like a reason for diversification and some of that sort of flight to quality, if you will, as a safe haven asset, that coming back into the marketplace. So I could see that helping at the margin too.
Okay. And what do you think could be a major surprise for next year? If you had to just guess, and one day you wake up and you say, "Oh my God, what a surprise! This happened." What do you think? Obviously, if you're telling us now, it won't be a surprise. But in in your in your opinion, what do you think is a big surprise for next year?
I think the one that the market would be most caught off sides with is that inflation comes down aggressively. And I think that is the one of the potential outcomes that I don't want to say is a high probability event, but I also don't think it's a zero probability event either. So to throw out an answer to you that potentially could pan out, that would be one of them. I think the market would certainly be caught off sides with inflation coming down much more aggressively than people are talking about right now.
All right, we'd love to, I mean, usually if I'm watching football, I don't like seeing offsides for my team, but in this case, we want to
Sure.
see some offsides there. Jack, any other thoughts, any closing thoughts that you want to give the audience?
Yeah, the last piece I would throw out there, and I think this is one of the things that I like to dabble in, is it's really investor psychology. And I would still argue that a lot of client conversations are still batten down the hatches. I'm still nervous. I'm still scared. We call it, I've labeled it 2008-itis. And certainly there's some emotional scars that run very deep because of what we went through during that period, especially for those who were close to retirement. That was a tough one. And so I think there's still that sort of idea of one foot out the door. And again, the conversations that we're having, people are very different. And so, as you mentioned, the offsides comment, again, I think a lot of people are still offsides, positioned very, very conservatively. And if we get any sort of good news in here, I wouldn't be surprised if, the markets still hold up. So that's the last piece I would point out. There's still a lot of people very bearish, money on the sidelines, cash on the sidelines. That's very important, I think, too, from a market perspective.
Excellent. And I did get one question from the audience, just talking about cryptocurrency. What do you think? Do you think that the government will regulate cryptocurrency? What's your thoughts on that?
Yeah, I honestly think you almost have to. I think the more and more you get these negative headlines from things like the FTX, that sort of thing, where maybe it's not crypto itself, but a lot of the the exchanges and the holding companies. I think at some point there you're going to have to step in and regulate. The other one I would point out to, this is one of the things we talked about in the height of crypto. If there's tax revenue to be had, the government will find a way to get it. And how do you get it? Well, you're going to have to regulate it. So. I think that's another way to think about this.
All right. Well, Jack, you said it all. I want to thank you for coming back to Coffee with Krav. You'll be getting your Coffee with Krav mug, the one of a kind, soon. And please don't be a stranger. Thanks for coming back, and hopefully we'll have you again in the future. So thank you so much, and hope a lot of the things that you had talked about does come through, and things will start looking a little bit rosier come 2023. So thank you so much, and we'll see you. Thank you everyone for listening, and we'll see you next time with Coffee with Krav. Thank you.